Welcome everyone to UMC's 2025 fourth quarter earnings conference call. All lines have been placed on mute to prevent background noise. After the presentation, there will be a question and answer session. Please follow the instructions given at the time if you would like to ask the question. For your information, this conference call is now being broadcasted live over the internet. Webcast replay will be available within 2 hours after the conference has finished. Please visit our website www.umc.com under the Investor Relations Investors Events section. Now I would like to introduce Mr. Michael Lin, Head of Investor Relations at UMC. Mr. Lin, please begin.
Thank you and welcome to UMC's conference call for the fourth quarter of 2025. I'm joined by Mr. Jason Wang, President of UMC, and Mr. Chi-Tung Liu, the CFO of UMC. In a moment, we will hear our CFO present the fourth quarter financial results, followed by our President's key message to address UMC's focus and the first quarter 2026 guidance. Once our President and CFO complete their remarks, there will be a Q&A section. UMC's quarterly financial reports are available at our website, www.umc.com, under the Investors Financials section. During this conference, we may make forward-looking statements based on management's current expectations and beliefs. These forward-looking statements are subject to a number of risks and uncertainties that could cause actual results to differ materially, including the risks that may be beyond the company's control. For a more detailed description of this risk and uncertainties, please refer to our recent and subsequent filings with the SEC and the ROC security authorities. During this conference, you may view our financial presentation material, which is being broadcast live through the internet. Now, I would like to introduce UMC's CFO, Mr. Chi-Tung Liu, to discuss UMC's fourth quarter 2025 financial results.
Thank you, Michael. I'd like to go through the 4Q25 investor conference presentation material, which can be downloaded or viewed in real time from our website. Starting on page 4, the fourth quarter of 2025. Consolidated revenue was 61.81 billion NT, with a gross margin around 30.7%. The net income attributable to the stockholder of the parent was 10.06 billion NT, and the earnings per ordinary shares was 0.81 NT dollars. Utilization rate in the fourth quarter is stayed the same as the previous one, around 78%. For the sequential comparison, revenue grew 4.5% quarter-over-quarter to 61.8 billion NT. Gross margin improved to over 30% to now 30.7%, or gross margin of 18.95 billion NT dollars. And the non-operating income remained similar to that of last quarter. And the net income overall attributed to shareholder of the parent is around 10.05 billion NT, or EPS of 0.81 in Q4 of 2025. For year-over-year comparison on page 6, revenue grew by 2.3% to reach 237.5 billion NT for the whole year of 2025. Gross margin rate is around 29%, or 68.9 billion NT. And for the net income attributable to the shareholder of the parent for year 2025 is around 41.7 billion NT, or 17.6% net income rate. EPS for 2025 was 3.34, which is a decline compared to that of 3.8 in 2024. On page 7, our balance sheet at the end of 2025, cash amount still more than 110 billion NT, with total equity of the company is now 379.8 billion NT dollars at the end of 2025. For ASP on page 8, you can tell for the last 3 quarters or 4, it pretty much remained similar level for our blended ASP throughout the 2025. For revenue breakdown on page 9, for quarterly comparison, the change is mainly showing in the increase in Asia and Europe, with now North America represent about 21% in Q4 of last year. For the full year breakdown on page 10, the change is similar. We see North America drop from 25% in 2024 to 22% in 2025. For page 11, IDM for Q4 revenue still represent about 20%, almost no change. But for the full year number on page 12, IDM account for 19%, increased by 3 percentage points to 19% in 2025. For quarterly revenue breakdown by application, it remained almost similar quarter-over-quarter on page 13. For the annual performance on the application breakdown on page 4, consumer increased by 3 percentage points to 31% from 28% in the previous year. And we continue to see 22 nanometer to be our key driver of growth for the recent quarters and also forward-looking as well. So 22 and 28 revenue in Q4 25 now represent 36% of the total revenue pool. On page 16, for the full year, the increase of 22 and 28 revenue is 3 percentage points. And we also show about 2 percentage point increase in 40 nanometer on a year-over-year comparison. Capacity remained flat on quarter-over-quarter comparison base, but it will decline by roughly 1% due to the annual maintenance schedule. On page 18, our latest forecast for 2026 CapEx plan is around 1.5 billion, which is slightly declined from 1.6 billion in the year of 2025. The above is a summary of UMC's results for Q4 2025. More details are available in the report, which has been posted on our website. I will now turn the call over to President of UMC, Mr. Jason Wang.
Thank you, Chi-Tung. Good evening, everyone. Here I would like to share UMC's fourth quarter results. In the fourth quarter, our results were in line with the guidance, with the flattish wafer shipments amid mild demand across most markets. The 4.5% revenue increase during the quarter was supported by favorable foreign exchange movement, as well as the sequential growth in our 22 and 28 nanometer systems, which continues to improve our product mix. With the 22 and 28 nanometer segment, 22 nanometer revenue increased to 31% quarter-on-quarter to a record high, accounting for more than 13% of total fourth quarter revenue. Looking at the full year, UMC delivered solid performance in 2025, with shipment increasing 12.3% and revenue in US dollar up 5.3% year-on-year. Going into the first quarter of 2026, we expect wafer demand to remain firm. UMC is confident that 2026 will be another growth year as the tape-out on our 22 nanometer platform accelerate, and other new solutions continue to gain business traction. We have been working hard to lay the foundation for our next phase of growth, investing for the future in both capacity and technology. In 2025, we complete the phase new Phase 3 facility at our Singapore Fab 12i, which is already playing a central role in supporting customers to diversify supply chain. At the same time, we are striving to expand our footprint in the U.S. through an innovative yet cost-effective mode of partnerships, such as our 12-nanometer collaboration with Intel and the recently announced MOU with the Polar Semiconductor. The leadership UMC has built over the past few years across specialty technologies, including embedded high voltage, non-volatile memory, and BCD, has and will continue to sustain stable business growth. Looking ahead to 2026 and beyond, we expect advanced packaging and silicon photonics to serve as a new growth catalyst, positioning UMC to address the evolving needs of a high performance of applications across AI, networking, consumer, automotive, and more. Now let's move on to first quarter 2026 guidance. Our wafer shipment will remain flat. ASP in US dollars will remain firm. Gross margin will be approximately in the high 20% range. Capacity utilization rate will be in the mid 70% range. Our 2026 cash-based CapEx budget will be $1.5 billion. That concludes my comments. Thank you all for your attention. Now we are ready for questions.
Yes, thank you, President Wang. And ladies and gentlemen, we will now begin the question and answer session. If you have a question for any of today's speakers, please press star key and number 1 on your telephone keypad, and you will enter the queue. After you are announced, please ask your question. If you find that your question has been answered before it is your turn to speak, please press star key and number 2 to cancel the question. Now please press star 1 on your keypad to ask the question. Thank you. Now first question will be coming from Sunny Lin, UBS. Go ahead, please.
Good afternoon. Thank you very much for taking my questions. So I have a few questions. Number 1, Jason, may we have your thoughts on overall market outlook for 2026, and then for semi versus foundry, and if UMC can continue to outgrow your addressable market for this year?
Sure. Well, for 2026, we expect AI-related segment remain as the primary growth driver in semi industry. And furthermore, with the continuous commercial deployment of edge AI applications, demand for chips using a general purpose server is also expected to rise. In contrast, the adverse effect of memory supply imbalance could put some pressure on specific consumer electronics, but overall, the semiconductor industry is projected to grow by mid-teens in 2026. The question for foundry market, we believe that AI demand will remain strong and is the main contributor behind the low 20% growth projection in the foundry market this year. On the other hand, although the memory pricing may impact demand of the foundry market at this time, we, as the UMC, we estimate that our addressable market will grow by low single-digit percentage, and UMC's growth was expected to outperform the average growth of our addressable market.
Got it. Thank you very much, Jason. So then my second question is on pricing. Lots of discussions, and obviously Chinese peers are raising pricing. So how should you think about the pricing outlook for mature foundry and for UMC through 2026? Will UMC be able to start to reflect better value? And if yes, which product categories should we expect more upside from here?
Okay, well, we do anticipate a more favorable ASP environment in 2026 versus 2025. This outlook really reflects our disciplined pricing strategy and the positive impact from multiple reasons: product mix optimization, loading improvement, and reduced exposure to more commoditized market segments. As you're referring to China players, We expect the strong growth momentum in our 22 nanometer demand to support our product mix in 2026 as well. Overall, our pricing strategy remains consistent and is anchored to the value where we deliver technology differentiation and manufacturing excellence. So we do think the 2026 pricing environment is more favorable now. Now, the question about which product, and I mean, we don't comment pricing on specific product or any specific note, but in general, we do see the environment is more favorable now.
No problem. That's very helpful. And then the follow-up would be on the overall industry supply versus demand for the coming few years. TSMC on the recent earnings conference talked about the plan to optimize capacity for mature nodes to better support cloud AI demand in coming few years. So from your perspective, how should we think about the opportunity here? Are you starting to see more client engagement for new products in the coming few years?
We're always excited to see more customer engagement. So, but more importantly, is we need to prepare ourselves to cope with the market dynamics, and we welcome any opportunity to support our customers. So we view this landscape shift as an opportunity to further optimize our product mix and gradually improve ASP and margin as well.
No, got it. And then maybe lastly, just on your Singapore expansion, how quickly are you planning to ramp capacity in 2026 and in 2027? And how should you think about the differentiations of products that you have for Singapore versus the Taiwan capacities for 22 and 28 nanometer? And then with that, how should we forecast the depreciation in 2026 and 2027?
Well, first of all, for the year of 2026, the capacity increase will be around 1.2% year-over-year for us. And for our Singapore facility, the expansion will start in the second half of 2026, and capacity deployment ramp from second half of 2026 will continue into the 2027. In terms of the node available in our Singapore facility, it's our strategy that we have a geographically diverse manufacturing footprint between Taiwan, Singapore, Japan, and U.S. And from a technology node coverage standpoint, we would like to coverage most of the nodes, so the customer has a benefit of crossing different specs support.
As for the depreciation forecast, we are looking for some like low-teen annual increase in the full year depreciation expenses. As for next year, we don't have the exact number yet, but it's very likely to be the similar amount for 2026. So in a way, we will see the depreciation curve to peak either this year or next year with very similar numbers.
Got it. Thank you very much.
Thank you. Next one, House Liu, Bank of America. Go ahead, please.
Yes. Hi, Jason. Congrats on the results, and thanks for taking my questions. I would actually like to follow up on the pricing. If we look at the like-for-like pricing environment, based on your current mid to high 70% of the utilization, if we strip out any of the consideration of the product mix improvements, are you able to improve or just to pass on your higher manufacturing costs or material costs to your customers at this stage, or you still receive meaningful pushback from your customers? Thanks.
Well, I mean, the pricing discussion is always ongoing. The overall pricing strategy remains consistent, as I mentioned earlier. In the 2026, we do see some market dynamics changes. So for certain customers, we do have some adjusted pricing upward, and for certain customers, we still have some of the pricing. Apply the one-time pricing adjustment at the beginning of the year to support their market share expansion as well as the competitiveness. So net, we think the environment is more favorable now in 2026.
Okay, yeah. So when you talk about when you are supporting your customer to gain market share by strengthening their cost structure, do you mean you are actually adjusting down your pricing for those customers, or it is actually up for this year?
We have a mix of that. For certain customer, we have adjust pricing upward, and for certain customer, we will apply the one-time price adjustment downward. Yes.
Okay, got it. And then just on near term, a couple of your fabless customers recently talked about earlier and also stronger inventory restocking because of the memory price hike. I was just wondering, what impacts your first quarter outlook here if your customers are seeing stronger inventory pulling in the traditional low season? Why is your shipment for first quarter is still relatively flat? And then what's your put and take for the first quarter overall business outlook? Just wondering which part of the business is actually relatively stronger and weak. Thank you.
Well, for Q1, by segment, we are actually in line with our addressable market seasonality. We didn't see significant changes due to the inventory restocking. But if you're looking into by applications, we expect the revenue contribution from consumer segment to increase, driven by the Wi-Fi and DTV and set-top box, while the revenue from the communication and automotive would decline due to a softer demand of ISP and DDI products.
Okay, that's pretty clear. And then since you just mentioned about the seasonality, are you expecting this year's seasonality to look pretty similar to the previous few years, that first quarter could be relatively light and second quarter and third quarter you will be able to see relative strength into the year?
If I can have probably provide you with this. If we look at the whole year, with the new project of a multiple specialty technology across the embedded high voltage, non-volatile memory, power management IC, RFSOI, it supports the end markets in communication, consumer, automotive, and AI server, which will ramp in second half 2026. So we're more looking at this year that our second half will outperform the first half. I'm sorry, the second half will be better than the first half. So that may be deviate from the traditional seasonality. But as far as for us, we think the overall shipment for the year will be a growth year, and as well as second half will be better than the first half.
Okay, yeah. And last question before I'm back in the queue is that just based on the comment you had just now, what is the underlying market unit demand assumption you have right now? Is it smartphone business, the overall smartphone market will actually grow or decline based on your current base case scenario that second half will be better? Or it is actually already factoring a relatively more conservative expectation that smartphone, TV, PC, these kind of consumer markets will actually see a unit decline? Thanks.
Well, with the current forecast from our customer, I mean, we do see gain on all cross segments, all applications. We do see some share gains on those applications. So right now the forecast does show us that's more of a share gain instead of market demand associated.
Okay, thank you so much, Jason. Qidong, that's pretty helpful.
Thank you.
Thank you. Next one, Felix Pan, KGI. Go ahead, please.
Hi, thank you for taking my question. I just have a couple of questions about the future growth driver, particularly in the remark you mentioned about advanced packaging and silicon photonics. So my first question will be, besides the interposer, what else we might have some engagement for advanced packaging, and for interposer, what's the capacity expansion plan for 2026? And my second question will be the silicon photonics, particularly in the Singapore fab. A lot of rumor about your potential customer. Is there any color, any kind of engagement, or any contribution can generate from this segment? Any color will be grateful. Thanks.
Oh, okay. A big question. see if I can cover it. And well, if I look back, I understand you asked for 2026, but let me look back. We have delivered a very solid 2025 performance with a 12.3% shipment growth and 5.3% revenue growth, which outperform our addressable market. This result is supported by our differentiated 22 nanometer technology and other specialty offering across both 12-inch and 8-inch amid a world-class market, the broad-based market demand recovery. And building on the 2025, we do view 2026 as a year of both continuity and evolution. We believe the UMC will once again taking shares and outperform its addressable market, and we will also see several positive inflation. First of all, as our guidance suggests, we are seeing a more favorable pricing environment. This will result in tighter supply globally, as well as our differentiated technology and geographical footprint, which will drive our growth for the next few years. We are on track with our 12 nanometer cooperation with Intel, which should start to tape out in 2027. Now, that's the existing one. And your question about silicon photonics and advanced packaging. Secondly, we see 2026 as a pivotal year for those high performance, high potential opportunities, such like the silicon photonics and advanced packaging. And we are making those deliberated choice, working with IMEC to invest and to scale them into a significant driver for our future. If you ask specifically about the advanced packaging, and they are two distinct opportunities for advanced packaging. One we call enabler, the other we call a TAM expander. Let us explain this. I know it's a bit long, but bear with me. So for enabler, we are seeing the 2.5D and 3D packaging, as well as the chiplet, move well beyond just the data center and ultra high-end chips and start to spread across the broader market. Over time, we expect advanced packaging to be adopted even on mature nodes. A good example is RF-SOI. We have mentioned many times where we're already in production. In addition to the RF-SOI, we're also exploring other applications with the leading partners and believe we are at least 2 to 3 years ahead of our competition. What this really means for customers is better power efficiency, more form factor, and more differentiated product. And for UMC, it is a strategic win-win. We believe our leadership in advanced packaging will enable us to capture more shares, sustain our higher ASP, and drive better margin in many of our already established business in the long run. On the TAM expander, we also believe that advanced packaging will help UMC address new opportunities. For example, customers are coming to us for AI-related applications. This is not necessarily just the XPU related, but we are adding value by stacking memory with the logic, adding DTC to the stack, or selling the discrete DTC. We are also working with our partner to enable a total solution. Meanwhile, we are working with more than 10 customers in advanced packaging currently and extend more than 20 new tape-outs in 2026. We foresee revenue in 2027 will be a significant year for us. And the capacity question you have, that capacity planning will be aligned with the customer ramp plan and market outlook. You also asked about the silicon photonics. For silicon photonics, we are developing solutions which include PIC, OIO, OCS, and CPO. Our collaboration with IMEC allow us to deliver in industry standard PDK to our customer in 2027. In addition to platform preparation, we also work with the customer on captive technology of 12-inch PIC, aiming for pluggable product, which is expected to ramp this year. We'll also combine our advanced packaging know-how with the silicon photonics, as many of the applications require the integration and different substrates, process, technology, and materials. Looking ahead, to achieve 1.6T bandwidth and beyond. We're working with both customer and vendor for the task finding on heterogeneous material, such as the TFLM. Those technologies could also be used in additional applications such as quantum computing. Again, we hope to integrate the new material via advanced packaging technology as well. So those are all integrated all together. That's why I gave you a bit of a longer answer. I hope that explains it.
Yeah, okay, thank you. But let me just quick follow up and rephrase my question. So for silicon photonics, what's the earliest timetable we can see the revenue contribution, like most likely?
For the 12-inch PIC, for the pluggable product, we'll be expecting to ramp this year. Okay.
And about the because as I know about the interposer currently is the interposer is also the bottleneck for our partner to expand their capacity. So is there any color we can how much capacity grows for the interposer, like how much year-on-year growth or something like that?
Well, right now the capacity planning will be aligned with the customer for the 2027 ramp. So we'll probably provide you some clarity when that comes. Right now, the 2026 will focus on the tape out.
Okay, thank you.
Thank you. Next one, Gokul Hariharan, JP Morgan. Go ahead, please.
Yeah, hi. Thanks for taking my question. Hi, Jason. Could you go a little bit deeper into that advanced packaging comment that you made? What is the involvement level of UMC in some of these advanced packaging solutions? Are you doing full stack, or is it basically like previously where you were largely focused on the interposer side of the equation? And in terms of the tape outs that you have, what are the nature of these tape outs? Are these mostly data center ASIC related products, or is it a much wider array of products other than just data center ASIC?
Sure. Well, first of all, we have reported, in our advanced packaging space, we have building some of the capability from wafer to wafer stacking and the TFD, as well as the interposer, the 2.5D, and the many different capabilities. And then the way we see it, like I explained, for the enabler is we can apply those to many of the current products that we currently serve. And then, and one good example I mentioned is the RFSOI. So we have a wafer-to-wafer hybrid bonding with the RFSOI solution for the mobile space already. And then some of the capability can be built for the DTC, capacitor for the stacking, and as well as some of the customers looking at discrete DTC already. And we're combining some of the capability into stacking the logic and the memory. Of course, we do not provide memory ourselves, so the customer will have to provide memory wafer to us, and so then we can provide the wafer-to-wafer hybrid bonding on those. So on one hand, the way we see it is advanced packaging is a capability per se, but it implies to a product, and then we call it an enabler and also expander. And meanwhile, the product coverage is all the way from the mobile space, power management discussion, the AI-related product, and also for the BCD application as well. So they will. It's our belief is for the form factor reason or for the higher performance reason, and many different applications will start adapting the advanced packaging. So we think this is going to be a broad acceptance on the advanced packaging space.
Got it. And any plans to further expand your interposer capacity? I think we had expanded, up to 6K and then kind of stopped it there. Now some of that demand seems to be kind of coming back for one of your customers in China. So is there any plans to expand the capacity further?
There are discussions around that. Right now, if you look at the technology itself, we have some common tools in place already, which that we can leverage. All from our 40 nanometer capacity, all from 65 nanometer capacity. From those common tool space, we're already allocating to this area. Now, for the unique tools, and we will put into a plan for the future expansion, and for the customer ramp profile, and we believe that will probably happen in 2027 for the unique.
Got it. Understood. That's clear. Another question I had is on the just your expectations for the communication consumer segment, which is north of 70% of revenue, given all these concerns about smartphone, PC. How are you budgeting for this? Are your customers telling you that they're really concerned about this memory cost inflation, or right now you still don't really hear that from the customers that that's going to be a big issue from a unit perspective going through the year?
Well, we're also cautious about that topic. As of today, we have not observed any demand impact on our customers' forecast for the year, despite that recent surge in that price. And our technology predominantly supported customers addressing the higher end of the market segment, where the demand tends to be more in the period of memory tightness. So because the supply usually typically prioritizing such higher value device, while we remain attentive to the potential impact on the memory market, and our current assessment is that any potential headwind are probably manageable, and we'll continue monitoring the situation closely with our customers together.
Got it. My last question is on the geographic split of revenues. Could you talk a little bit about the Intel 12 nanometer progress and any color on how you will be booking revenues or profits from this partnership, given the fab is Intel's fab, while you are essentially the provider of customers and some degree of IP as well into it. And secondly, on the Xiamen fab, what is the strategy for the Xiamen fab medium to long term, given many of your semiconductor peers in Taiwan have kind of progressively exited capacity in mainland China?
Well, for the 12 nanometer project with Intel, overall the 12 nanometer cooperation project with Intel continues to advance smoothly. We remain on schedule to deliver the PDK and associated IP to customer in 2026. Furthermore, we anticipate the product tape-outs will commence in 2027, making the significant step toward to a commercialized deployment and future revenue growth. Right now, UMC and Intel are working closely to ensure successful tape-outs and an efficient ramp-up for the mass production. As the project advances, it is expected to further strengthen UMC's position in the U.S., right, for customer as well as for us, because the geo diversification manufacturing. Right now, the application on the 12 nanometer collaboration, including products on digital TV, Wi-Fi connectivity, and high-speed interface products. In terms of the business model, and it's probably not available for us to comment, but it is a win-win strategy that we see and will be very synergetic, for both parties as well as for our customer, and we have very high confidence this will be a win-win model.
Okay, and any thoughts for the Xiamen capacity?
Yes, for the Xiamen, I kind of touched that earlier as well. I look at Xiamen, not just Xiamen itself, is, our core part of our competitive advantage is our geographically diverse manufacturing footprint. And the Xiamen, play one of the, important place for us, and particularly for the local customer. So and at this point, the fab is actually at a full capacity. We are running at a full utilization as well. And we see we continue seeing many different engagement coming to this, and we will, across regionally optimize this, from the customer engagement and product loading standpoint.
Okay. Just one more on blended ASP. I think, Jason, you mentioned that the ASP environment is more favorable this year, but overall utilization is still in the mid-70s as of Q1, right? So do you expect that this year we could see a scenario that we could see blended ASPs moving up meaningfully, like 5 to 10% or something like that, like we have had in the past, or that requires a much higher level of utilization that is probably not happening this year, given your low single-digit foundry growth expectation?
Sure. I mean, the high utilization is one of the important factors, but that's not the only factor. We want to make sure the pricing strategy is enable not only ourselves, our customer to be competitive as well. So, but we do see the pricing environment is getting more favorable to foundry because the loading reason, and so, but the magnitude of that, we probably have to continue managing it. And if we have a clarity, we'll share that with you.
Got it. Yeah. Thank you.
Sure.
Thank you. Next one, Alex Chen, BNP. Go ahead, please.
Thank you for taking my question. I just have a very quick one. I just saw the company announced that it started the mass production of the SuperFlash Generation 4. So just wonder, how much revenue contribution from the non-volatile memory business in the past quarter or maybe past year, and also how much revenue is contributed by the power management ICs for the server-related applications. Thank you.
Well, I mean, we don't have a breakdown provide, and the way that we break it down is based on a specialty technology that includes the high voltage and non-volatile memory and the BCD space. Right now, the specialty revenue representing about 50% of our overall revenue, and I can let you know the high voltage is about 30% of that, and the rest of it I would say is a combination of the non-volatile memory as well as the BCD.
Thank you very much.
Thank you. Next one, Laura Chen, Citi. Go ahead, please.
Hello. Hi. Thank you for taking my question. Good afternoon, gentlemen. I just want to follow up on the utilization rate and also the gross margin outlook. Jensen, you mentioned that the pricing environment seems to be improving and more favorable, and together with the firm shipment and the better product mix as well as utilization rate. So how should we think about the gross margin trend? You guided that will be high 20% for Q1, but with these variables factors, how should we think about the margins throughout the year? That's my first question.
Well, yes, when gross margin can be highly dependent upon utilization rate, ASP, product mix, duration, and foreign exchange rate. So there's a lot of variables. So beyond this quarter, it's difficult for us to give a firm outlook. For the first quarter guidance, which is high 20s, is mainly due to the higher cost, especially the higher depreciation expenses. As I mentioned, it will grow by low teens in the full year of 2026. As for 2026, we will continue to cope with the higher depreciation expenses, as well as the other inflationary pressure for our production, raw material and other costs. To mitigate and cope with the headwinds, we will continue with our cost reduction efforts and also all the activities to improve our productivity and drive operation efficiency. And these measures hopefully will help UMC to deliver a stable EBITDA margin and ensure our long-term financial resilience to remain intact. As a matter of fact, our 2025 EBITDA margin is actually a good improvement compared to that of 2024.
Yeah, sure. Thank you very much. And also, I think for the advanced packaging and as well as the silicon photonics is one of the key things that UMC may have a great opportunity. We know that UMC has already working on advanced packaging previously on interposer. Probably now we'll see more various different design. So could you share with us what about the revenue contributions of your advanced packaging right now, and how would that look like in 2-3 years?
Well, currently, the interposer was exposed to very limited customer base and also narrow application. While we have engaged with more than 10 customers and expecting more than 20 new tape outs in 2026, we do foresee that revenue of packaging, advanced packaging growth in 2027 will be significant.
So significant means that could that be like 5-10% or higher?
Oh, I expecting half more than that. So, but I mean, if you're referring to the overall revenue contribution, we will probably give you more, a guidance later. But if you're just looking at the packaging itself, it's going to be significantly larger than what we're shipping today.
Okay, thank you very much.
Thank you. Next we'll have Bruce Lu, Goldman Sachs, for questions. Go ahead, please.
Okay, thank you for taking my questions. I want to go a little bit deeper for the silicon photonics. I mean, as you might know that your peers like GlobalFoundries, Tower Semi are pretty vocal about that. Can you tell us how big you think the addressable market for silicon photonics for you guys in 2 years, and how do you win market? What is the competitive advantage for you in this business, though? I mean, other than working with IMEC.
Well, I mean, the Singapore facility is not going to only serving the silicon photonics. Singapore facility is one of our important manufacturing sites. It serves our worldwide customer all different applications, and so it's part of our geographical diverse manufacturing strategy. So,
No. My question is for silicon photonics business strategy.
The silicon photonics strategy.
Yes.
In Singapore. Okay. So.
No. I'm sorry. Let me rephrase my question. So
Sure.
the growth driver for UMC, one of it is the CPO. I'm assuming is having more business in the silicon photonics. For your peers like GlobalFoundries or Tower Semi, they are pretty vocal about the silicon photonics and have meaningful revenue contribution already. For UMC perspective, what is your competitive advantage for UMC to win this business, and how much business you can win, or how big is the addressable market for you in 2 years?
Got it. So for the silicon photonics, our strategy is simple. Our collaboration with IMEC allow us to deliver the industry standard PDK to our customer in 2027, particularly in 12-inch. So many of our competitors today at the 8-inch, and we are focused on this in 12-inch. And as we believe the 12-inch will have that advantage. And right now we already have certain products that proven that performance is better and on a profitable product, and which we will expect to ramp this year. And meanwhile, we're also combining with the silicon photonics with our advanced packaging know-how. So for many different type of applications that we can integrate that. So by doing that, we think we will be providing even more value from advanced packaging combining with silicon photonics at 12-inch. I think that's where we believe we are competitive.
But that's mostly for plug-in, right? Because if you don't have the EIC, the pure CPO product might not be your key growth driver.
you're correct. We're not looking at a completely CPO package. We're looking at particularly in the PIC and OIO and OCS.
I see. Understand. It's very clear. Next one is, and we do see that the progress with the progress for the Intel projects for 12 nanometer is pretty smooth. I just want to know what is the next step. I mean, when we can see a further collaboration in 10, 7, and beyond. I mean, obviously, whatever you said, if the advantage at 12-inch, you can also use the same argument for 7 nanometer. What's stopping you to do that?
Well, you're also right on that. And our focus right now is on delivering the 12 nanometer platform to customer. In the future, should it make sense for both UMC and Intel as well as our customer? We will surely consider expanding our collaboration to other derivatives as well as the technology. Yeah.
But what is stopping now? What is the showstopper now?
It's not. I won't call it stopping. I think the focus is a focus on 12 nanometers. We have to deliver the 12 nanometer today, and make sure that we deliver that program. We execute it well, and I think anything that makes sense from that on, like you said, I think there will be a discussion. Yes. I
see. Because we are already assumed that you can deliver something in 27. So, given that working for 7, maybe you need 2 years, we want to see the project kick off as soon as possible. That's all my question. Thank you.
Sure.
As a reminder, please press star key and number 1 on your keypad if you would like to ask the question. Thank you. Now we'll have our last question. Sap Ho, Neuberger Berman. Go ahead, please.
Hi, Jason and Chidong. It's been a while, and congrats on the progress you've made throughout these couple of years. I just have a few questions. The first one is on the market dynamics. I think previously Sunny has asked about the TSMC is shrinking or defocusing on the mature foundry process. And it looks like not just TSMC, but also the other foundries seems to be doing, some leading edge logic foundry seems to be doing the same thing. And also Power Chip recently just reached agreement with Micron, selling this Tongluo fab, which means they're trying to streamline and reorg some of the foundry process too. So it seems like there's a lot of supply is kind of being taken away because of the rolling out effects from the AI and crowding out some of these older nodes. On the supply side, seems to be that's actually decreasing. And on the demand side, if you look at, I think TI just reported overnight, I think it seems like there's been more obvious recovery on the analog MCU space. So on demand side, that's also improving. But the supply side, that's actually decreasing. So it looks like supply demand dynamics is moving to a more favorable situation. I think that explains why you were mentioning the pricing dynamics is favorable this year. So I'm just curious about your view. If we try to compare the current, like the mature foundries dynamic situation right now versus, back in 2021 when there's a severe shortage back then, how would you compare this time around versus last cycle?
That's a really good question. We saw some of the market movements, the changes, and we also did a deep dive on this demand and supply outlook, and we think whether this is short term or long term. If you look at the driver behind this, we see you mentioned this is truly more the AI phenomenon ripple effect. And so we see that AI demand remains to be very strong, at least at the foreseeable future. And driving the overall demand. And meanwhile, many of the capability, AI capability, will portfoliating to even the other end market devices, in the edge AI as well. So we think this will continue. And from an economic standpoint, building any of the mature facility is not justifiable. So we do think this could last longer compared to the COVID time. And I think this situation could be more of a structure going forward. But again, this is at a very early stage of this market movement. So we'll pay attention to it and we'll continue monitoring the progress. Meanwhile, like I said earlier, I think it is more favorable pricing environment, but more importantly is we need to prepare ourselves to cope with this market dynamic. So we are welcoming all the opportunity that for us to engage and supporting the customer. But the important focus today is we have to get ourselves ready to capture those opportunities.
Got it. Another questions I have is your earlier comments on the pricing. I think you offer some of the annual maybe some discount to some of our strategic clients for their share gain, but also net wise, you also seems to be pricing is going up for majority of the clients. So net is going to still be the ASP still be positive. But I'm just curious about for those clients that you're offering some discount at the beginning of the year, when it down the road, if the next few months or quarter situation has become tighter, and would you be able to reprice with these customers?
I mean, those discussions will be ongoing. We're always working with our customer to reflect the market dynamics as well as the cost increases. So, I believe this conversation will surely happen. It happened in the past, it will happen now, and it will happen in the future. So, this pricing discussion will continue, and I think customers understand that, and we just have to continue monitoring the market dynamic and maintain our competitiveness on both the customer and ourselves.
Yeah, well, follow on that because of some of the pricing that started to effective on the January 1st this year. This was actually negotiated already in fourth quarter last year, right?
There's some alignment on that on both volume and the pricing. So if a volume has changed, of course, that's a different topic. So there are some volume dynamic in that as well.
Yeah, my question is actually that because a lot of the pricing that effective on January 1st, beginning of the year, was actually communicated a month or 2 months ago before that, toward the end of last year, when the time that the supply demand dynamics haven't been really that tight as compared to some of the changes that happened in the just past couple weeks. Am I getting that right?
Yeah, you're right. Yeah, but those also is on certain conditions. So given the condition has changed, some of the pricing are dynamic.
Yeah, exactly. That is exactly what I'm trying to discuss with you, because we also saw a lot of the other different components or different subsectors within the tech or semi supply chain that, like such as memory. I think the pricing were still down in July, August, but all of a sudden September price is going up. So I'm just curious about that because when you negotiated some of this discount months ago, the supply demand dynamics was not the same as today. So right. Things remain fluid, dynamic, and it's still going to be flexible, and it's going to be dynamic and open for changes down the road if things are moving more favorably.
I think the core of the pricing strategy is that it has to be consistent and it has to anchor with the value that we deliver, and also the customer competitiveness. That is the core. Then usually that is how we centering about the pricing discussion. So that core is not compromised. Now, if the condition has changed, yes, they always have some flexibility to it. So pricing strategy and position, and now that it's called pricing negotiation. So there will be some flexibility, yes.
Yeah, and the condition has started to change now.
Yes. So
okay.
we do think the price discussion will be more favorable now, yes.
Okay, cool. Thank you, and Happy New Year.
Yeah, you too.
Thank you. Ladies and gentlemen, we thank you for all your questions. That concludes today's Q&A session. I'll turn things over to UMC Head of IR for closing remarks. Thank you.
Thank you for attending this conference today. We appreciate your questions. As always, if you have any additional follow-up questions, please feel free to contact ir@umc.com. Have a good day.
Thank you. And ladies and gentlemen, that concludes our conference for fourth quarter 2025. Thank you for your participation in UMC's conference. There will be a webcast replay within 2 hours. Please visit www.umc.com under the Investors Events section. You may now disconnect. Thank you again. Goodbye.